Yeah, hello and welcome back to that lecture here on international taxation. This is part 40 already of the international taxation introduction. That is a great feeling for me because 40 parts, okay. Um, let's celebrate that for a minute. However, for you it is probably hard if you looked or watched already the first 39 parts, and you probably think, oh my god, how many of these parts are still to come? The answer is I don't know. However, we have just begun, or we are going to begin just the last chapter. That's chapter 4, tax planning. So using the knowledge which we have obtained during the first 3 chapters now for planning and optimization ideas. Tax planning, why is that topic so important? Tax planning has, in the international arena, dominated the political discussion strongly during the last years and decades. Probably most of you have already come across journal articles, newspapers, and things reporting that multinational enterprises have very often got away more and more with paying only a ridiculous amount of their profits as taxes. And the states have even begun to react by cooperation. They have joined in the OECD together with many other states and have developed a program to prevent or cut back international tax planning as much as it's possible. You have probably heard about this BEPS project, so the base erosion and profit shifting program, where the OECD has undertaken the attempt to prevent and restrict international tax planning more than before. So the topic is evidently of high interest. So, but first we should think about, before we talk about international tax planning, we should develop some more precise ideas what it can be. So what or how can we define international tax planning? That should be our first question before we talk about it. Usually one describes in the first attempt international tax planning as measures by which people try to minimize their tax burden. However, that's not a very adequate definition, because if you take that serious, minimizing the tax burden would mean your aim is to bring down your tax to zero. That would, for example, require that you say, I want to have an income tax of zero, so I bring my income down to zero. That brings you into poverty, not into happiness. So it must be understood that tax planning should evidently be defined as tax minimization under a restriction. So tax planning is probably better defined as activities undertaken with the aim to lower the tax burden under the restriction or condition that the gross income stays at a comparable level like before. Or you might even more precisely define it as activities which are undertaken with the aim to increase the net income of somebody, of an enterprise, for example, by taking measures to lower its tax burden. So this would automatically imply that you don't want alternatives by which the main target of the enterprise is brought to zero. You would automatically say we only minimize taxes if it leads to higher net outcome, which is reasonable. Yeah, so that would be a better definition, because it makes clear a rational taxpayer does not want to minimize taxes. He or she wants to maximize the net outcome, and reducing taxation is only allowed, desirable also, under the condition that it brings a higher net income. a higher net outcome. Now, when can we expect something like tax planning to take place? First, the idea of tax planning implies that you have a choice between two things. It's not just foreseeing the tax burden, it's planning the tax burden. That requires that you can make decisions and have choices. On the other hand, what we know is whenever somebody has choices, he or she must make choices. And a rational decision maker will always make that choice which maximizes his aims, or the consequences with regard to his aims. So when we have two different tax rules, which basically lead to the same gross or comparable gross outcome, then a rational taxpayer will always decide for that economic alternative which triggers the lower tax burden. That is built in the situation because you have a decision problem, you must analyze your alternatives, and you will decide for that alternative which brings the higher outcome with respect to your aim, and your aim is a net profit. So it's always pre-programmed that under the condition that your gross income does not change considerably, you will probably always decide for the alternative with the lower tax burden. You can observe that in real life easily. For example, in Germany, we have a rule that selling a house leads to, if that house is private property, that selling a house then leads to taxes, income taxes on the gain from selling the house if you sell it within the first 10 years after acquisition. If you sell it at a later point of time, it will be tax-free completely. Now it's understandable that German house owners have a choice: sell within the first 10 years or sell after 10 years. And whenever somebody has the possibility to select between the two alternatives, for example, if there is a possibility to sell after 9.5 years and 10.5 years, and the gross price which you can obtain will not considerably fall down for the second alternative, then they will always decide to sell after 10 years. It's pre-programmed and built in the system. So that's foreseeable entirely. It's also underlined that if Parliament writes rules like these, the taxpayer has a legitimate right to choose that behavior which ends up with the lowest tax burden. Because Parliament has written the rules, they knew about that, let's say, 10 years limit, and they have consciously decided that if you sell after 10 years, then you don't pay a tax, and they know you have a free choice, so they wanted this, they accepted this. And traditionally the idea is, if the tax legislator does not like the outcome of the situation, then it's seen rather as a duty of the legislator to draw the consequences and change the legal situation, so to remove the differences. You can illustrate that, for example, from German tax history. Until the year of 2009, current income, let's say current interest from a capital investment, was taxable. However, selling a capital investment was, under certain circumstances, free of tax. So the whole capital market in Germany was busy in creating capital investment possibilities where you got all your profit, all your income from gains from selling the capital investment, and nearly nothing from current returns. That was pre-programmed into the system. It brought more and more difficulties. And so in the end, in 2009, the legislator drew the consequences and removed that difference from tax law. Nowadays, we have a rule that current income is income from capital, 21 ESTG, and that gains from selling a capital investment is also income from capital, 22 ESTG. So here, legislator must react. naturally. And until they react, you have naturally the phenomenon that people will try to generate, even artificially, the second alternative, which is better for tax. You can also not bring forward that it's not legitimate to use these opportunities, because when you respect the legislator, so the function of parliament, its advisors, and all the people who are involved in writing a law, then you must necessarily say that if the legislator decided that one alternative action should lead to a tax and another one should not lead to a tax, this decision of the legislator must be respected as such. If you say, yeah, legislator said there are these differences, but you should not make usage of them in a reasonable way by choosing the better alternative, then you can only justify that under one or two assumptions. First, the first assumption under which you can justify that is the legislator was an idiot. That's not rather respectful, because it requires the necessary assumption that you, the person who now says that Parliament was an idiot, are wiser than all the experts of your country who sat down and debated that. Second, you might also assume that Parliament was a liar, because Parliament said there are two options, the one, the other. You have the free choice. However, I expect that you don't use your choice in a way which is foreseeable. So to give you the permission to do something free of tax, however, to expect that you don't do it. Both things end up logically that you have to conclude here is an individual, let's say a civil servant in the fiscal administration or several civil servants in the fiscal administration, who just say we know better than Parliament. That implies we are bound by the law, to stick by the law. However, we decide when we really take the law for serious, and there are other cases where we say legislator was an idiot, so here we don't stick to the law, but what we think the legislator should have written if he had a better understanding of things. So here people then replace the decision of the lawmaking bodies by their own idea of what these bodies should have written. That's a constitutional problem, because if you give in to that tendency, naturally that also means that the respect before the actual decisions of Parliament is undermined completely. So it's difficult to say that tax planning is not legitimate. Well, you end up in grave logical problems. Nowadays, however, you have very often a distinction between there is tax planning, which is completely legitimate, and there is some other form of tax planning, which is called by the people in play aggressive tax planning. Now, aggressive tax planning is something which is completely unwanted, illegitimate, and which, let's say, nice guys shouldn't use. Now, that's again a question, a basic one, because here you again convey that notion that there are certain tax planning measures which are legal, because tax planning is always playing with the rules and not against the rules, which is completely legal but should not be used, so not legitimate. It again implies that logical contradiction that the law allows you a certain behavior, it is legal what you do, but expects you not to make usage of a permitted activity. And that negates the very nature of allowing something, because allowing something and say, I allow you something, but I expect that you don't do it, that mixes up allowing and forbidding. And it's extremely detrimental to such fundamental ideas like legal certainty. Um, Due to these logical implications of the idea of tax planning is not legitimate, that Parliament necessarily then must be seen as an idiot or a liar. The idea of an aggressive, unwanted, illegitimate tax planning can only be upheld, if at all, in situations where the assumption is justified that the legislator has not seen all the situation, all the choices which his decisions in writing the law open for citizens, or that Parliament has seen these alternatives but had no chance at all in changing the situation and setting better rules. Only in these two situations it's logical, justifiable at all to say that something which was or is permitted by the legal rules should not be used. However, if you see it that way and draw a line or see a justification for the term aggressive tax planning based on such assumptions, then you must also draw consequences, because the longer such options which are unwanted are known, the less legitimate must the label aggressive tax planning become, because when the legislative bodies have seen the taxpayers' opportunities for a while and do not react, then somebody must then form an opinion if the inactivity of Parliament is not perhaps to be seen as the conscious decision of them not to act or not yet to act. So again, you override their right to write the laws by saying, I am wiser and my decision counts more than the decision of the parliamentary body's constitutional problem back again. So seeing tax planning as something which can be, let's say, attacked under present legislation is inherently problematic in an unavoidable way. That is the first thing you should keep in mind. The only way which we should have is when there are differences, or when the rules lead to results which we don't want, then we should change the rules and learn. So let's make a kind of a subtotal, a conclusion, an interim conclusion. First, let's sum up. Wherever you have two equivalent actions available which are treated differently by tax law, rational taxpayers will undertake that action which leads to the lower tax. So differences in tax rules always trigger tax planning. That's pre-programmed, built in, and absolutely unavoidable, because everything else would be an unreasonable behavior and you can't demand that from anybody. Now, number two, when you have an international playing field, there you have always different tax rules for nearly everything, because let's imagine you have 200 different countries worldwide with a different tax system. So every state has for the same thing its own tax law and rule. So a certain behavior triggers a certain tax under the laws of state A, but necessarily something different under the laws of state B or state C. So you have always alternatives which are different tax outcome. So the mere existence of different tax laws in different states all over the world automatically triggers international tax planning. And that tax planning is also possible for nearly everything which you can do, because nearly everything is regulated differently in different states of the earth, because tax law is not harmonized. So this automatic existence of tax planning opportunities could only be changed if the differences between the tax laws of different states would vanish, and that is something which is nowadays completely not realistic. We do not have a worldwide identical income taxation. However, it might be that evolution leads us to something like that, just because this problem as such might be intolerable, so we need to react in the only logical way. A last remark must be made. Why, if that always has been the case, is international tax planning only a problem during the last, let's say, 30 years? And why does the problem increase more and more? Well, you can only influence a decision, or you can only use these things for your decisions if you first know about them, and second, if you can really use the alternatives. So taxpayers can only do international tax planning if they can reasonably precisely know about the different treatment of certain activities in different states. Nowadays, that's possible in contrast to former years. We have the internet, we have international tax advising firms, we have international networks of tax advisors. So you can obtain the information and the help which you need to perform certain activities in a more favorable tax jurisdiction. It's nowadays possible. Second, you must have the realistic chance to really act within a foreign jurisdiction instead of being bound to your home state. Nowadays, that's possible. In former times, it was difficult or unusual or too risky to set up, let's say, a company or permanent establishment in a foreign state. Nowadays, it's everyday business. Everybody can probably set up a company, a subsidiary, or what else in every foreign state. Nobody complains if you bring some jobs or so there. So the two hindrances for the problem have fallen away more and more during globalization. And that is the reason why nowadays tax planning has become from a theoretical problem to a more and more actual problem, and why it is so relevant. Now, there is still the notion in the heads of many people, yours, mine, everybody, that most activities in economy have a certain given place, which is rather regarded as its natural place, natural location. And when you shift something to another place, this is rather artificial or something like that. So that some activities are bound by nature to a certain location, and shifting things to other places is rather unnatural, artificial, or things like that. Now, the first thing you must see is that economically, nearly every activity which somebody undertakes can be split up into smaller parts, and that these smaller parts can be outsourced, let's say, to other firms which are specialized on that, and these other firms can do that business at another place. So economically, many things are perhaps traditionally done at a certain given place, but economically, this is not a God-given rule or law or paradigm. So when you split up these things into smaller units, that's simply division of labor. That's economically normal, a sign of progress. It's even recommendable that you hand over a part of what you do to a highly specialized unit, which does it for lower costs because they can use economies of scale or things like that. So splitting up a once united activity into smaller units and relocating them all over the world is probably economically recommendable, if not mandatory, for progress, especially if your activities get bigger and bigger. Now, splitting them up into different parts and organizing each partial activity in a way which is optimal for it might be necessary. It might be a necessary driver of economic progress. Even it might be mandatory under other aspects because Let's imagine you aim at the world market, and now all you do is done in your home state. Then the other states of the world and their populations, public opinion there, will view you as a foreign enterprise which plunders their market, gets rich from their customers, and does give nothing back. So even under a political aspect, it might be highly recommendable to do things like this. Not only under the economic aspect, specialization, um, also under the political aspect, and to maximize your long-term survival chances, it might be highly recommendable to split up your activities and relocate them all over the world so that every region gets a bit in the activities and profits from it, so that everybody sees you as positive for that country. Um, so it is, if we outsource a bit of our activities and place it somewhere else, probably just a natural behavior, not an artificial one. However, we did not see it in former times, because in former times the world was more local. But if you analyze the things which you do at a given location, you find many things which could be moved to other states or other regions. Example, imagine a coffee selling chain which has shops in every city. Let's call it Starbucks Coffee. And now you assume naturally that when you sell coffee to consumers, you have to do everything that in that coffee shop, so that the coffee shop is the God-given location for your activities. However, let's make a thorough analysis. Naturally, you sell coffee to the final customer. That must be done where the customer is. But you have to purchase that coffee first. Where you have your purchase department is not God-given. If you have, let's say, 1,000 coffee shops worldwide, it's definitively a good idea to centralize your purchase department at one location, because then you have the better opportunities to negotiate with the sellers and get higher discounts for higher purchase volumes and so on. So outsourcing the purchase of the coffee, separating from the location of the job, is really probably compelling under the cost aspect. Where do you roast the coffee beans which you bought? Well, naturally not in every individual coffee shop. Okay, so you have to centralize that also at a location, and you have to decide where. Probably at the best possible location. Everything else would be nonsense. It's definitively a strange idea to say we do it in every local coffee shop. The production of the coffee cups in which you fill that coffee is naturally not done in every of the local shops. Also, that will require a factory, and if that factory belongs to you, you will place it in the best potential location with a look to the wages, the employment regulations, the environmental production regulations, the customs duties consequences if you set up that factory in a part of the world where you don't need the cups, but where you have to export many of them, and all that stuff. But there is no God-given place for that. You will select from all places all over the world. That's simply natural. The marketing activities, if you have such a global chain, then you should have a coordinated marketing approach. Where do you place your marketing department? Well, God knows. There are 200 plus X different states in the earth available. More cities even. So where do you go? You can decide. The business concept is probably nowadays, with a chain, very often developed by somebody at a certain location. It will be further developed and updated and so on. Where do you do that? Also there is no God-given location for that. So when you look to what you do in such a shop or a restaurant or something like that, many of these activities cry for being outsourced. and then you don't have a given location for that. Who could expect that a chain with having 100 or which has activities, local shops in more than 100 countries of the world is bound by a certain logic or loyalty to set up things in their home state? Why should they? Nowadays, they are often stock corporations, so their shareholders come from all over the world. So a loyalty to the home state of the investor would probably be not feasible at all. So you have to make decisions on all these individual points. It's not a bundle which is not separable. So that automatically triggers international tax planning in an international world. Then another example. Let's imagine a gold mine or a coal mine. Naturally, you can only set it up where that raw material can be found. So you have the idea, okay, now here at least there is no tax planning possible. Here is a God-given location where things must happen. However, also here, when you look more into the details, to extract these minerals from the soil, you need technology. You have to construct these technologies either yourself or you have to buy a license that you can use them. That patent right can be held or can have been developed all over the world, but because patent rights, that is about ideas, and ideas can happen all over the world. So where you place your research and development department, or where somebody else who developed the technology and sold it to you, where that somebody else placed its development department, that's complete coincidence. Then you extracted raw material from the soil. However, you will have to process this until it is a refined final product. So yeah, where do we do this? That's a function of the transportation costs. If the transportation costs are very, very high, you have to do it on the spot where you extracted it from the soil. However, if transportation costs are relatively low, then you can also do these additional working steps at any other given point of the earth. You have to sell wholesaling and retailing activities, possibly. Also, where you approach your customer. That's not necessarily there where you extracted things from the soil. So many decisions also here are not bound to a certain location. So also here you have a choice from many international options. Also here, tax planning automatically comes into play, because when you think about if you do it in France or in South Africa, you have to opt for the whole bundle of conditions for the location France. That implies also taxation. Or South Africa, that also implies South African taxation probably. So whatever can be separated can be freely located. And also taxation will play a role among other factors if you can use that or not. So nearly in every potential case of an activity in a globalized world, a considerable part of your activities can always be placed globally. So tax planning is an unavoidable problem nearly everywhere in nowadays economy. And you can't talk it away. You can't say it's unnatural or something which should not exist. It's simply built in the way how our world is organized. And that makes that problem so immense for the further development of legal rules and of our legal system. Which elements are core elements for triggering tax planning? In the international system, we have rules which give the right to tax to the country of residence of the taxpayer. that immediately can be seen as giving the taxpayer a factual option. You can set the facts in a way that you can choose where you pay. If you are a natural person and the right goes to your country of residence, you can move your residence and move somewhere else. It's rarely done. However, it's possible. And it's expectable if the tax advantage is high enough and the other disadvantages are small enough. However, furthermore, a taxpayer can also be a juridical person, so a company. Everybody can nowadays set up a company in a foreign state, in nearly every other foreign state. So setting up a company in a foreign state as a subsidiary and having this company then do the activity which otherwise you would have done is easy and can be done everywhere. So this is a factual choice given to the taxpayer by the existing rules in the double taxation treaty. However, if that is also not possible, then so that, let's say, somebody from Mexico can have a tax advantage over yourself, then you will try to get this tax advantage by outsourcing that activity genuinely to that Mexican unrelated person and then sharing the tax advantage via the market price mechanism. So this set of rules is highly important for triggering tax options, naturally. Second important element, contracts between the taxpayer and the company of the taxpayers. So a company which is closely related are accepted by tax law. So it's a business expense for the one person and a business revenue for the other person. That is the case as long and as far as the conditions are market price conform, so arm's length principle. That's justifiable and completely logic, because what you do with your own company is only what every other participant in the market could also do with you and would otherwise probably do with you. So you do not shift something completely artificial there. What you do here is you make choices which are in general possible, and you do these choices as if other participants in the market would do them. However, that principle makes it completely possible to outsource a part of your activities to companies in other countries and still keep the profits within your own group. Yeah, and that naturally is used in combination with rule number 1, the residence country taxation. Now this explains the importance of the rules of transfer pricing nowadays in our economy, because every multinational or every enterprise playing on a global scale will make use of that. Seems to be clear. Yeah. So what can legislators do if they want to limit the effects of tax planning? Well, we found out that wherever you have differences in tax rules, these differences will be used by tax planning. So what a state can do is removing the differences between the legislation of the states. Either you could harmonize the worldwide tax legislation. We see certain beginnings of such an economic pressure when we look to the current tendency to enforce a global minimum tax on corporations. Or you could say, when there is a difference between my country's taxes and the foreign country's taxes, we compensate that tax advantage if somebody uses the foreign tax jurisdiction by giving these people an additional tax burden in their home state, which exactly compensates the tax advantage from using the foreign jurisdiction. That is a already traditional approach. In the so-called controlled foreign companies taxation, you can find it also in the newly established American GILTI tax system, or in a worldwide application of the credit method. However, that would end up in a situation where in the world market, a taxpayer who is resident in a 50% tax country is taxed with effectively 50% total tax burden for his or her profits all over the world, whereas his competitor resident in a 20% state has areas where he or she gets away with 20%. So it would end up in strong distortions of competition, and in the longer run, the taxpayers located in the country A would have grave disadvantages in competition. So you uphold your tax claims, but in the long run, you damage your tax revenue sources massively. So, first idea. Second idea, remove that rules which make it possible that you can be treated under the rules of a foreign tax jurisdiction instead of the jurisdiction of your home state. So revoke the applicability of a double taxation treaty, for example, either for all cross-border constellations or for all constellations in which the wish to lower taxes might have played a role. This has already begun. See the MLI introducing the so-called principal purpose test. The benefits of a treaty are by this rule revoked, denied, whenever there is a justified suspicion that tax motives played a role in what the taxpayer did. However, that's highly detrimental to legal certainty and to innovations, because adaptation or adjustment to the requirements of a globalized economy is hereby cut back. You can't do something new. If it could be seen as tax driven, then it would entail huge problems. So you probably have to stick to traditional behaviors in a highly developing global surrounding. Problematic. And the last but not least possibility would be just to forbid your people to actually act in foreign countries at all. So to cut back economy to a completely local scale. These would be the possibilities. And this shows how enormous consequences all that topic of tax planning has. Wherever you have the global playing field, you can have tax planning. It only vanishes when the difference between tax rules vanish or you have distortions of competition. However, either you have to remove all those differences or you will have to live with these things, and so to develop completely new concepts of tax laws which do not really are under or exist at the moment or are yet under discussion. So that is why I want to talk to you a bit about tax planning in this chapter of the lecture, and I hope you can get some insights. But that is enough for the introductory part of this chapter and enough for this video for today. So I thank you very much for listening and hope you come back soon. Thanks, goodbye. Don't forget to recommend the channel to people whom you like or to people whom you don't like, depending on the situation, if you appreciate the videos or not. Okay, ciao.